please turn over the microphone to Mr. Jesse Myers. Thank you so much for joining us today.
Thanks for having me, everybody. Okay, so I guess I do have some slides that I'll use to structure this. So how do I use share screen, right? And then select this, and I share that, and we'll just go into that. Okay, yeah. So we'll talk a little bit about my path and what I don't know. I guess what lessons poly students might be able to take from what I've learned and the mistakes I've made and the lessons I've picked up that were helpful along the way. And then we'll talk about Bitcoin, cryptocurrency generally, and why that's a big deal, which really kind of goes through a little bit of backstory of what is money before you can understand what is Bitcoin and how it fits in to what's going on. And then why this might matter to you as students as you head off into the world, because you're living in a really interesting time in the history of money with the digital revolution in general. And then we'll talk about whatever you guys are interested in. So, all right, so a little bit about my path. So I went to USC after poly, and I was a neuroscience major. I was just really interested in that topic, but I knew I wanted to get into business, so I got a business minor. And turns out you can't really get a job in business, or people won't take you seriously, at least at that moment in the business cycle. It was 2009 when I was trying to get interviews. So yeah, I was stuck. I had no options coming out of undergrad. I had failed to get a job with my degree. So my solution was to go and get the credentials and create the experience that I didn't have. I didn't have any internships that I needed, that I realized now I needed to be taken seriously for business job applications. So I went and got a master's of accounting, which was painful and difficult and taught me the language of business and was a really valuable skill, and got my foot in the door as a serious business applicant for jobs. At the same time, I started doing the numbers for my friend's surf apparel company, just a small startup, and became a co-owner of that and ran the business side of that small little startup that was insignificant, but showed that I was, really walking the walk and interested in business, and that helped get my foot in the door with a lot of different promising interviews, and that led to a job at Bain & Company. Something I didn't know until my senior year of college is there's a whole industry, a profession called management consulting, where you can get a job coming out of college working as a management consultant, which really just means a business strategy, jack of all trades, where you come in as part of a firm that's hired to solve some hard problem that a business is facing, and they don't have the expertise or the manpower to figure it out. So just FYI, that's an option to you, and an amazing place to start your career, because you learn everything about business, and you get really good at Excel and PowerPoint really fast, and the overall professional development there for the first couple of years is unmatched. So just FYI, it's a great option. From there, I went and got an MBA at Stanford, where I had already learned I'd already learned about business from my job at Bain, but I picked up some valuable lessons when I was getting my MBA. Just some things that professors said along the way that really stuck with me and led to my next step. So one of them was, you get 5 swings in your career, and you just need one of them to really connect. And so that was an interesting, tidbit to have stewing in my head. The CEO of the chairman of JetBlue said to us, I know many successful CEOs who are unhappy, but don't know any successful entrepreneurs who are unhappy. So that was a lesson there too, that there's something to be said for creating your own thing and freedoms that creates. And then the biggest one was, time and again, these people who had been early in some wave of finance or venture capital or tech up in Silicon Valley, they would say that the opportunity had passed, that you should have been there. Anybody who was there at the early days of venture capital or private equity or leverage buyouts, everybody was a success, but that's past. That time is over. So the best you can do now is start a company that I'll invest in or work for me and be my minion. Those are the things that these guys kept coming in and saying. And what struck me was that people who are established are unprepared for what's new. They don't recognize when a new wave is happening. It's the young people who take a risk, who put themselves in a position to be in a new and emerging industry that reap the benefits of that. So that really, those things all together led me to take extra interest when I was struck by cryptocurrency when I was at Stanford. Some of my more technical classmates were interested in it. The nerds were excited about Bitcoin and Ethereum, and that told me that I should pay attention and I should find out why. Why are so many of these people who are really smart really interested in this thing that doesn't make sense to me and doesn't seem to matter to me? And when I dug in, I started to learn why. So I eventually decided that that this was a big wave of the future and something I wanted to take a swing at. And so I started my own cryptocurrency investment fund called Protocol Capital, just a one-man shop. And my thesis was focused on a diversified portfolio of promising technologies. This is sort of the Silicon Valley tech investing playbook. Invest in technology, invest in what's new, and hope that one of those is a big winner. And that sort of worked. That worked well in 2017, and then it did not work in 2018. The bear market, if you've heard about it, that we went through in 2018-19 crushed my thesis. It was wrong, and the thesis was wrong, and I had to figure out why. So I failed. My investors were down a lot. What did I miss? Why was I wrong? This was the tried and true playbook from Silicon Valley. And so I forced myself to dig in and go really deep into staying curious and staying open to reasons why I was wrong, things I'd missed, paradigm shifts that I wasn't prepared for, or that my background had caused me to miss. And in doing that, I have come to, after now 5 years in cryptocurrency, 4 years running a fund, I now pretty deeply understand what's going on with this new asset class and why that thesis was wrong. And so we can get into what I've learned and what I think everybody should be aware of, particularly as you're heading off into your careers and thinking about how to store your money, and what type of money to trust into the future. Okay, so what is money? That's where you have to start to try to understand cryptocurrency and Bitcoin in particular. Money is dollars, right? It's what the government says is money, and that's all we think about. But what does that mean? Well, dollars are an asset that they're printing more of every year, and in fact, they're accelerating the printing of it. So over the last 10 years, they've actually been adding 8% every year to the amount of dollars in existence, 26% in the last year because of COVID. So by design, the dollar loses its purchasing power. And that's because there's an intentional inflationary schedule built into how the government thinks you should treat your dollars. You should spend it rather than saving it. But it hasn't always been this way. So money before dollars was gold. And gold has different properties from dollars, but it has a tendency to be centralized because it's heavy and you end up storing it in vaults, and then you take promissory notes against those dollars, and then you've created paper currency. If you go even further back in history, so gold is the emergent victor from thousands of years of human history of different types of money being used. And then when different civilizations with different types of money as their standard came into contact with each other, one of those standards would win out. And so it's sort of this bracket, this sports bracket over time, where gold was the victor over thousands of years of human history. But why is that? It's because it's the hardest to make more gold. Gold is scarce. It's easy to make more shells or more beads, but it's very hard to create more gold out of thin air. So it becomes a reliable store of value. It becomes not just a collectible, but something you can trust to store your value in because you know it's rare and other people value it. So that's why gold was the victor over thousands of years of human history. But we've been living in this strange anomaly in the last 50 years, where since 1971, we've gone off of the gold standard. So dollars are no longer backed by gold, and that's recent. Only been 50 years that's happened. Before that, for thousands of years, gold was money, and that's why it's possible to print more money now than ever out of thin air, because you can, and that's why that trend is accelerating in the beginning. But that puts us in an interesting point in time that you all should be aware of. We are living in the middle of the digital revolution, and that has sort of already happened for the digitization of information with the internet. But the complement to the digitization of information is the digitization of value. So how we store value, how we transact value, that's still analog for the most part. That's still paper dollars, that's still gold. It's all very old school, because to date it had been impossible to keep value from being copied. And when you put anything on the internet, it becomes information, and information can be copied. So you couldn't reliably put value on the internet, but that's where Bitcoin comes in. So Bitcoin is the invention of digital scarcity, the first system where it became impossible to copy any unit of value that was placed on the internet. Now for the first time there's digital scarcity, and it's an elaborate system, an engineering breakthrough, an unbelievable design that makes it so that it's impossible to copy somebody else's value or steal somebody else's value, and obviously that's a breakthrough for the internet. So that's why we are now entering into this new era of the digitization of value for the first time. So and Bitcoin is also, it's a protocol rather than an application or a company. And what does that mean? It's hard to understand the magnitude of that. But when we think about the internet, that's all built on top of the internet protocol, the TCP/IP, which is just a set of rules for how You can exchange information on the internet. But it's not possible to own TCP/IP. So instead, all you can do is you can own a share of something like Google or Netflix. But with Bitcoin, because it's a value protocol, a protocol for how you exchange value on the internet, by definition, there's a ownership layer, value layer that has to have an owner, and that's Bitcoin, the currency. So that's a big distinction that everyone should be aware of about what Bitcoin is it's not a company, it's the Internet of Value itself. And what's unique about that is that you can actually have an ownership stake in that total Internet of Value, the complete economy built on top of that protocol. So what makes Bitcoin special in the history of money is its monetary policy. So that's what's shown here on the left. The blue line is how many Bitcoin are in existence over time, and then the x-axis there is shown in Bitcoin blocks, and there's a block every 10 minutes. So really each increment there is 4 years, and you can see how every 4 years the slope of that line changes, it decreases. In the first 4 years, half of all the Bitcoin that will ever exist were mined. And then in the next 4 years, half of the remainder, and then half of the remainder again. And so you see how it's asymptotically approaching its maximum supply of 21 million. So there will only ever be 21 million Bitcoin. As the first time in history, there's a finite supply store of value. With gold, they're still mining 2% more gold every single year. So there is no cap on the amount of gold that can exist. There's not even a cap on the amount of land that can exist, because you can always turn swamp into farmland or create islands out of the sea. So it's the first time in history that you've had a finite supply store of value. And what's really interesting about that is on the right here, we see that shortly after the reduction in mining issuance, there's a spike in Bitcoin's price that it tends to run up in the year following each of these changes in the amount of Bitcoin being issued per day with mining. So on the right, if you see how there's sort of a stair-stepping pattern, the start of each stair is what's called the halving. So this moment in time on the left when the issuance rate suddenly dropped by half. That's what's called a halving event, and we see that's what seems to be sparking these Bitcoin bull markets. So in the year following, we have these runs. So you see in 2013, it's harder to see, but in 2017, that stair step begins, and suddenly the bull market plays out. And then what's even more interesting is May 2020, we had the last halving, the most recent halving. And since then, we've been in this bull market that's been building steam. The blue bars, the channel going up and to the right, is this particular price valuation model based on stock to flow of Bitcoin, using the past data to predict in the future what future halvings will cause. We'll see if that plays out. But the important point here is that Bitcoin is appreciating in value every 4 years because of the reduction of its issuance. Therefore, its increasing scarcity is what is driving its value upwards over time. And that's never existed before with any asset, because it hasn't been possible to do that. And so that's a real paradigm shift for people to be aware of. So yeah, the result of that is that Bitcoin has this unique attribute that no other asset class in existence has, which is it has increasing scarcity over time. So if you zoom way out, and you're capturing many of these 4-year cycles, these reductions in issuance and therefore increasing scarcity, the pattern that emerges is this, where on a logarithmic trend line, the Bitcoin's price is exponentially growing because of the increasing scarcity that happens over time. So what does that all mean, and why is it important for poly students and the poly community to be aware of? Well, it's a big deal because of what it might mean for how we store our money and what currency we tend to use in the future. So, these are some big names who have recently become passionate about Bitcoin's potential. And, everybody has this misconception about what it is, or, on the surface, you think it's monopoly money or just some clever science experiment. But when you dig in deep and understand the implications of digital scarcity and Bitcoin's properties in comparison to other store of value assets and other forms of money, you become pretty bullish. So so some people are increasingly aware of it, and it's being talked about a lot right now, especially because of the halving last year driving the price up, and that's what we're living through currently. The price is a big number, but it's still incredibly early in terms of total adoption. There are only 10 million people in the world who have $5,000 stored in Bitcoin. So that puts us really early in the classic tech adoption curve. And Bitcoin's still tiny. So if you line it up with all the other buckets of store of value assets, the size of other asset classes, Bitcoin is a drop in the bucket still. And if its properties of increasing scarcity and eventually becoming the most scarce asset of all of these options, if that drives it to continue to eat market share away from these other alternatives, then Bitcoin could become a large bucket on this map. The full potential is so big that it's hard to entertain. But if you take a look at all of those asset classes and consider what chunk of that Bitcoin might steal away as it becomes a more scarce store of value class than those existing asset classes like fine art or real estate or gold. It's possible that Bitcoin's terminal value is something like $10 million per Bitcoin in today's terms. That's possible, and it's crazy to say that. And that's the 20+ year timeline. But that's what we're living through, is this digital revolution. And suddenly there's a store of value asset that is better than every other store of value asset in existence. So yeah, just a summary of the points from before there. And now we can talk about whatever people have questions about and want to talk about. So I'll open it up for whoever. How do I
have a few questions that came in beforehand, so I'm going to read them off. But students, if you have questions after, just feel free to unmute yourself and go ahead and ask. So Jesse, can you speak to just the safety of crypto? We have a lot of questions about how safe is cryptocurrency and how companies keep that money protected.
It's interesting. It's more safe than anything else, but it comes with a different set of risks that are very scary. So a Bitcoin address cannot be hacked. It relies on math, the cryptography that has been proven out over the last 30 years. All the cryptographic experts are not at all concerned that it could ever be broken. So in that sense, it's extremely safe. But what that means is you are responsible for controlling your own private key, which is just a really long password that is what it takes to control a Bitcoin address. So if you have that private key, you can send the Bitcoin from an address to wherever. And that's all important. And all it takes is a single person getting a screenshot of your private key to steal all of your money. So the methods for keeping that safe have evolved and have gotten very good, but it is a learning curve up front that all companies and all individuals have to go through to keep their assets safe. But once you figure it out, once you've properly set it up, it's it's the best Swiss vault you can imagine.
Thank you. And then someone is asking about the difference between Bitcoin and altcoin.
Yeah. So for whatever reason, the space has sort of evolved to have this umbrella term of crypto for everything. And crypto sort of means Bitcoin, and then all of these other attempts at leveraging Bitcoin's innovation to either create a competing currency or use that for some other use case. Like Ethereum is intending to do smart contracts and simultaneously trying to be money itself. But Bitcoin has that use case on lock, and the network effects are run away, and it's not going to be caught for that. So the differences are really come back to like what is the use case that an altcoin is trying to use digital scarcity to do, and those have been, there's 8,000 altcoins out there, and besides Ethereum, none have amounted to really anything yet. And I think that's, when you really dig into the history of money and how money tends to one, that was the case with gold, sort of the case with dollars too. That's going to be 95% or more of this market, maybe 99%. So all the other altcoins are sort of fighting at the margin for a tiny slice of this total market, and Bitcoin's going to be the winner for 95% of it.
And I think you kind of touched on this earlier, but how do you see Bitcoin increasing in the next 10 years?
Yeah, so I sort of tried to, hint and drop that in there, but I see these 4-year cycles continuing. I think that, the story that the media totally misses about Bitcoin is that it's all about the halvings, and the halvings drive scarcity, and scarcity causes an imbalance in supply and demand. When you suddenly are halving the amount of supply, but demand isn't changing, you're creating a supply shortage, and that shortage becomes acute. And as it becomes acute, the price starts to go up. And when the price starts to go up with this type of asset, it attracts more demand. And that's how you get these bull markets. And those bull markets happen after each halving, in the year and a half after each halving. And then there's a crash. So there's a crash that lasts a year or two, and then a stabilizing final year before the next halving. And then it repeats all over again. So that's going to keep happening for the foreseeable future. There's some talk about, at what point does the world figure that all out and it all gets priced in? Maybe that happens sooner than later, but I think that the next 10 years is probably going to be major bull market and crash and recovery every 4 years for the next 10 years. And that, I think, will lead to, 10 years from now, I think a Bitcoin price of $1 million per Bitcoin is probably where we're going to be, something like that. And FYI, that so there's only 21 million Bitcoin, but they are divisible to 100 million subunits called Satoshis, sats. So when you're buying Bitcoin, you're really buying sats that add up to these large whole Bitcoins. So it's not like if Bitcoin is $1 million per coin, then suddenly people can't afford it. You can always buy, the fractional units.
Thank you. Does anyone have any questions for Jesse right now?
We have one question from the alumni board. So just for those who joined us late, I'm the head of the campus and student outreach committee on the alumni board, and there are some interested alumni board members. Well, question I have for you, Jesse, and this is, I don't actually know how to ask this appropriately, so forgive me. The rise of quantum computing has the potential to challenge the mining rate of Bitcoin potentially. Do these words make sense to you? Is this something that you think about as going forward as computer power starts to geometrically accelerate? Does that threaten the halvings in terms of the volume of coins that can be then discovered, or how does that play out?
So a couple things. I guess I'll parse out the misunderstanding and one of those.
Thank you.
Things. So one of the clever parts of Bitcoin's design is that the amount of Bitcoin issued per day is fixed. And so if there's more computational power mining, it doesn't actually produce more Bitcoins. It just changes the amount of competition for the fixed amount of Bitcoin being released. So, we've seen a geometric increase in power on the mining network, but it doesn't change Bitcoin's issuance. In terms of quantum computing, that's kind of one of the buzzwords. There's a certain set of surface level concerns that people have that sound pretty persuasive, but when you dig in, aren't really concerns. One of them being quantum computing, the other being energy consumption. Bitcoin actually is fantastic for the development of renewable energy and utilization of stranded fossil fuels like methane that just gets released into the atmosphere currently, but with Bitcoin can be turned into productive energy and then processed into CO2 and water, which is less damaging for the environment. But that's a different thing. Quantum computing is not really a concern. And this is where it does get more technical than I can keep up with. But the technical experts in the Bitcoin space are not at all concerned about quantum computing for a number of reasons. Because Bitcoin is a living, breathing protocol, you can update it to get ahead of any potential brute force capabilities of increasing computing power if we need to. So if suddenly quantum computing is emerging and computers are getting 1 billion times more powerful, you can make Bitcoin 1 billion times harder to crack. You can just update it. That's one thing. I'll leave it there because the other stuff is pretty technical, and I don't understand it that well. But suffice to say, quantum computing is not a concern at all for the experts.
Thank you. I will update the board accordingly.
We got Paige here.
Hi, thank you for coming in today and talking to us. I appreciate it. So since cryptocurrency and Bitcoin are all like pretty new things, how does that affect, at least in your job, building a diverse and overall successful portfolio? And with like all of these twists and turns and possibilities that you talk about, how do you kind of like, you know, build that portfolio to set you up for success in the future?
That's an awesome question. And it's sort of backwards. I came in with that mentality of you should approach an investment portfolio with diversified assets, because that's what works in tech. That's what works on the internet, right? Because there are different internet companies built on top of the internet, and it's not possible to own the internet itself. So the best you can do is get a good diversified basket of those companies built on top of it. And that's how I approached crypto at first, and that's where my thesis was wrong. We've seen how the bull markets with crypto, the monetization of this new asset class, the growth of this asset class, happens after the halvings. And what's driving it right now is the adoption of Bitcoin as part of treasury reserves for large companies, and billionaires storing their wealth in it. So, I came in with a diversified approach, and then had to be rudely awakened that that's not actually the recipe for winning in crypto. The winning formula here is to recognize that this is a winner-take-all game, and that Bitcoin is now $1 trillion in value, and the network effects of that kind of scale are insurmountable. And the total potential of Bitcoin is still like 200x from here. So that's the play, is to get as much of the Bitcoin network ownership as possible, store your value in that, and let it continue to have its halvings, and let the world continue to realize that this is an asset that's not going away, and is a viable alternative, and in fact, a preferred alternative to storing your value in dollars or even real estate, specifically because it is increasing in scarcity over time, and that causes the value to go up over time. So yeah, it's been a funny reverse journey of going from believing that diversified portfolio is the way to go generally, to recognizing that Bitcoin is the play here, and just owning as much of that as possible. For what it's worth, because there's only 21 million Bitcoin, if you divide that by all the people on the planet, each person on average can only own 0.0025 Bitcoin. So, and that's about $130 today. So if this thing becomes the preferred store of value, or at least a major asset in everybody's portfolio, that $130 could be, that's a person's net worth potentially, in the scenario where 50 years from now it's the dominant money on the planet. So that's the kind of upside that's still possible with Bitcoin, mostly because it's still so early and people don't know about it or understand it, but it's continuing to emerge because of its inherent mechanics and properties. And that's what we're living through.
Can you talk a little bit about running a one-man shop and just the process of starting your own company?
Yeah, starting an investment fund is very hard, just because you have to figure out all the boxes you have to check, all the hoops you have to jump through. It costs like $50,000 up front between legal fees and regulatory filings, and you have to go actively court the third-party companies that you need to have. You have to have a third-party accountant, so you have to go find that, and you have to have an auditor and a tax firm. Those are all in place to make sure that your investors have safeguards, and your investors know that somebody else is double checking that you're not stealing money or something. So that's all expensive and takes time, and you have to set it all up. And then you have to go, pitch your investment thesis, your understanding of the world and this market to potential investors, and you get a lot of rejection. And then some people are excited about it and introduce you to their friends, and you have a lot of conversations. So it took me about 6 months to set everything up and get going. And unfortunately, that was the prime bull market. So by the time I launched it, it was just in time for the bear market in 2018. So pretty rough timing, but there's a lot of work upfront in setting up an investment fund. And then after that, there's a lot less work. You still have basically a monthly cadence of having to update all the accounting, and the accounting books are updated with a snapshot at the end of each month, and you have investors coming in and out, adding money or withdrawing money. All has to be administratively handled by you. But that's the once a month cadence, and then the rest of the time you're changing your thesis or monitoring assets or just reading a lot about the market, trying to understand what's going on, what you're missing, what's changing. Is there anything new that you need to be aware of? You need to you have an obligation to update your investors about or get them exposure to. So it's a lot of reading, which is pretty interesting in this space, and then a lot of sitting. So one of the harder things to do is when the price is dropping and you want to do something about it, the best thing to do is nothing and wait it out, and that is hard mentally, but you get better at that too.
Jesse, can you talk about the the global scope of Bitcoin, if there is one?
Sure. So yeah, one of the advantages that Bitcoin has is that it is fundamentally global by nature. It's borderless. One of the challenges with sending dollars somewhere around the world is there are banking restrictions and regulations on that. It takes time, it's expensive, and that's not true with Bitcoin. So with Bitcoin, you press send and it arrives 10 minutes later, anywhere in the world. It's truly borderless, and that has meant, so that is one of the tailwinds behind this thing. It is really tailor-made for the internet. The internet is global and instant, and Bitcoin is the native currency of the internet, and has those same properties. It is interesting seeing how the emergence of the Bitcoin market globally is different in different places based on regulations and opportunities. Mining in particular is very interesting to see it evolve, because by definition, the highest input into any mining companies' operating expenses is their electricity costs. So it makes sense to do Bitcoin mining in places where you have the cheapest possible electricity. And this tends to mean places where there's excess electricity production, like in the Sichuan province of China, they have a lot of hydropower and way more than they use. So they have this unused electricity that goes for very cheap. And so there's a lot of Bitcoin mining happening there. And it happens seasonally too, where Bitcoin miners come in during the wet season when there's a lot of energy production. And then they leave during the dry season and go somewhere where there's cheaper alternatives when there's not as much energy production. So yeah, I guess the most interesting dimension of the like global nature of Bitcoin is how there are different opportunities for mining in different geographies, and the game theory that comes out of how different countries have to wrestle with this new thing. So some countries try to ban it, like India recently, because they want to control their own currency, and this is a threat to that. But the game theory doesn't really work in the favor of countries that try to do that, because you're stymieing innovation. You're literally telling people who want to innovate in this new asset class to go elsewhere, and you're sending wealth somewhere else. And that's one of the reasons why, like, the U.S. hasn't even tried to clamp down on this, because they don't have any ability to do so or legal standing to do so. But also because they were really smart with the internet and allowed it to develop with light regulation, and as a result, the U.S. has been the center of innovation for the internet, and they want to have that same leadership position with this new movement. So yeah, I guess that's just a couple of the interesting dynamics that are playing out that different nations have to evaluate. And the game theory points towards, like, you don't want to miss out.
Okay, we have about 5 minutes left, so I'll say last call for questions. But if not, then we can wrap it up.
One question for you. One more question for you, Jesse. So we hear terms like forking.
Yep.
For example, with Ethereum as a cryptocurrency, I'll use the collective we here so I don't out anybody's lack of knowledge, believe that when you fork something like Ethereum to create a new cryptocurrency, you do so with sort of an existing protocol. Maybe you add on some special sauce. So if Pepsi has a Pepsi coin, well, maybe there's some benefit when you go to Knott's Berry Farm and you get free sodas or whatever. When you talk about Bitcoin and forking, I don't know if this is the right term, but there is something called Bitcoin Cash and Bitcoin other things, dollar. Explain exactly what are these and how do they relate to Bitcoin overall?
Great question. So yeah, there are two different types of forks. One is called a soft fork, where that fork is backwards compatible, and another is called a hard fork, where you're changing some core rule in the protocol, and that makes it no longer backwards compatible. So the forks that you hear about are the hard forks. The soft forks are updates, really. Hard forks, like Bitcoin Cash, create a branch in the ledger, where when the rules change, that ledger becomes its own thing, and the same rules continue on as its own thing. Back in 2017, the Bitcoin, there was sort of an attempted coup to take over Bitcoin from corporate interests, and that was Bitcoin Cash. So the idea there was, let's change one of the core rules of Bitcoin to allow the blocks to be bigger. So every 10 minutes, there's a block, and all a block is a set of a bunch of transactions that are processed in a batch, and that batch happens every 10 minutes. That's one block, is a batch. And the block size is 1 megabyte. So you can fit as many transactions as you can into 1 megabyte, and then that block is full. And in 2017, a bunch of companies and wealthy early Bitcoiners tried to increase that to 2 megabytes. And that would come with a whole bunch of other trade-offs of the centralization of Bitcoin nodes, because suddenly you're making it more costly to run the Bitcoin software, because suddenly the files are bigger. but it also, much more importantly, creates this precedent of you can change Bitcoin. And that's what the companies wanted to do. And that's what the community did not want. So, the Bitcoin won because the Bitcoin community said you can't change Bitcoin, because otherwise it's not a reliable, credible money into the future. And so that's why Bitcoin emerged out of that as the victor, and now Bitcoin Cash is 1% the value of Bitcoin. But it's really just a separate protocol entirely that had its origin at that moment in time when they changed the rules.
So just to piggyback on what you just said there, for those I can tell who are a little bit anxious, is there, how many times are there events or decisions where, quote unquote, the Bitcoin community, which you, I think, said were early, very large coin holders, like, do they vote? Like, what if someone said, you know what, instead of 21 million Bitcoins, we should probably have like 22 million Bitcoins.
Yeah.
We should have an extra million. And like, could someone just say that at the Bitcoin roundtable, wherever that exists, to go, I want to do it. Everyone goes, yay. And there's suddenly a million more added. And everyone goes, oh my God, I got diluted. Like, how do people make these? What is this shadowy organization? It sounds very James Bond-esque.
Yeah. So it's very hard to do that. It's by design, it's very hard to create a change in Bitcoin. People have to elect into, they have to signal that they want a change. And it's the way that is voted on is by nodes, which is really just a computer that is running the Bitcoin software. So if you have your computer running the Bitcoin software, you have a node, and that node has a vote in any potential changes. But you have to proactively signal that you would like to change this specific thing. And the community doesn't want to change Bitcoin. It's very, because of the Bitcoin Cash attempt. One of the big learnings that came out of that is, Bitcoin has value in large part because it is unchangeable. And so we must not change the core of it. We can innovate on top of it, second layer innovation networks that plug into the base layer, but you don't want to change the base layer itself. So yeah, in terms of like, is there an organization that's deciding how, what changes happen to Bitcoin? No, it's totally decentralized. The organization is the people running the software, and they have to proactively signal that they want a change. And if they signal a change that doesn't reach, critical mass, they're left out on their own. So you don't want to be left out in the cold like that. So you're highly incentivized to not change anything that makes it not backwards compatible. But there are small changes that happen somewhat regularly that are backwards compatible and improve Bitcoin in non-essential ways. So yeah.
Thank you.
Okay, well, this was a lot of really, really good information. So thank you everyone for attending. Thank you, Jesse, for speaking with us.
Thank you for having me.
And I'm gonna go ahead and I can send out some of the materials that you showed to everyone here today so they can take a look after.
Yeah, sounds good. Thanks everybody, and hope you take interest in it and dig into it and learn more about it, because I think it's either going to change our world or it won't.
Thank you, Jesse. This has been fantastic. And thanks everyone for attending.